Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Jobless claims this morning, 225, the estimate 221. The previous week, a revised 219. Into tomorrow, payrolls. The estimate in our survey, 150. The previous month, 142. Mike McKee, thank you, sir. With us now is Lindsey Piegza of Stifel. Lindsey, let's talk about the numbers that just came out. Anything to fear? Anything to worry about looking at the labour market data through this week?
Really not yet. The jobless claims seem to be pretty steady. We have seen a little bit of weekly volatility, but nothing to indicate a sizable directional trend. Right now, we continue to see that the labor market remains tight-ish, with some indications of cooling momentum. But again, that cooling suggests the data is simply moving more towards a neutral state as opposed to an indication of mounting weakness as we look further to the end of the year and turn that page into 2025.
Where do you get any degree of confidence that we'd stabilise in this state at this level?
Well, I don't think we're going to get much confidence from jobless claims per se, at least not the weekly data that we've stabilized. Big confidence is going to come from more improvement or more stabilization in the non-farm payrolls report. So Friday is going to be a very key driver, not only for confidence for investors, but for the Fed officials looking to make that determination of what's the appropriate next move for November and December. If we see more indications of cooling momentum, I think that's going to bolster the case for a larger, more aggressive second round 50 basis point cut. But if we see more steady conditions, if we see more stabilization, that's going to make it pretty difficult, coupled with earlier uneven inflation data from the PCE, to justify anything beyond a 25 basis point cut. And should we see the numbers come into the upside, I think the Fed may be willing to sit on the sideline and take a pause in November.
Forgive me, because I've been conditioned by experience, Lindsey, but every time we're heading into a non-farm payrolls, everyone says this is going to be decisive. It's going to tell us where we are in terms of on the brink of some sort of deterioration or some, steady as she goes type of state. And then it comes out and people find 15 different narratives to justify within that same data. Lindsey, why should this be any different?
Well, I think, again, it's not the end all. It's not the deciding factor for November, but it is one of the key pieces. We have a handful of key data points between now and November, and the Fed is going to look at them in their entirety. So coupled with the idea that the PCE, yes, it's a key driver, but it was mixed. It was uneven. The headline retreated. The core showed further upward momentum. Now, we're going to turn our focus to the labor market. If the labor market comes in very clear to the upside or the downside, that's going to be a very key driving factor to that decision. But again, if it comes in mixed, the Fed is likely to say, well, we need more indications. We're going to wait for a next round of inflation. We're going to wait for the next round of the employment data. So it's not that one data point is going to make the decision, but each of these data points becomes increasingly more important as the picture is not yet clear as to what the Fed should be doing and the size and the momentum of these policy adjustments that the market is anticipating.
Lindsey, how much salt, though, needs to be thrown on the next data point of the non-farm payroll report on November 1st?
Well, there is going to be some adjustments that have to be taken into account. Of course, the port strike, of course, the hurricane, all of these events are going to provide additional volatility. But it's likely that we do see most of that volatility not necessarily hit the November report. It may take an additional month to come through. That being said, if we did see that type of distraction or volatility, the Fed can also look through that. So yes, there is some amount of we need to look at the data point with a grain of salt, given the underlying factors, these one-off effects. But the Fed is smart enough to look through that. They're going to see the underlying directional momentum. And again, that's going to help decide where the Fed policy needs to go from here.
What's your best guess for tomorrow?
I think we are going to see something similar along what we saw last month. I think 140, 150,000 is very reasonable, keeping us on par with, again, the pace of job creation, raising the three-month average closer to around 130,000. But the unemployment rate still steady around 4.2%, well below what the Fed has designated as that full employment range or the sustainable level of joblessness. So I think we get a somewhat favorable report still indicating tight-ish conditions and still indicating the need for a very patient, tempered, controlled reduction of rates as, again, inflation, their job of reinstating price stability has not yet been met.
Lindsey Piegza of Stifel. Lindsey, thank you. Posen of the Peterson Institute with this to say: I stand by my call that the Fed will stop cutting rates by March of 25 and will be hiking by June of 25, seeing a 40% chance if Harris is elected, 85% plus if Trump is elected. Adam joins us now. Adam, welcome back to the program, sir. We've got a lot to work through here. Let's just start at the top. Why is the outlook for you in 2025 so election dependent?
Thanks for having me back, John. I think it's election dependent in two reasons. The first is whether it's Harris or Trump, I think the commentariat and a lot of the market people are overestimating the likelihood that a divided Congress will prevent fiscal expansion. You will get some fiscal expansion if it's Harris, and you'll get outrageous fiscal expansion if it's Trump. And Anne-Marie and I have talked about this on a previous appearance. I think Congress is not going to block it either way. The second reason is specifically to do with Trump. In a recent analysis the Peterson Institute put out last week, we go through very carefully what his plans for general across-the-board tariffs, particularly migration, deportation policy, and interference with Fed independence would mean. And that puts you at an inflation rate of well above 4% easily.
And you've made the argument also that you think the Fed should be preparing for two-way risk and should be preparing market participants and the general public for two-way risk as well. That reminded me, like it reminded you, of the situation that Governor Carney was in back in 2016. Why do you believe that's the right idea?
I think, John, thanks for having me back to talk about this. And you're right about the parallel with the Bank of England facing the Brexit call, something very political where they don't want to come down politically, but it's disingenuous to just sit there and say, well, what'll happen is what'll happen. I mean, in the end, that is what will happen. The Fed doesn't affect the politics or the outcomes. But if you're choosing to just every meeting just tack back and forth and update people's expectations, you leave a lot of room for volatility, and arguably you're going to cause more harm to the economy. Sometimes you have to be honest and just say, look, we are not going to pretend we, the Fed, have a view on Trump versus Harris, but we think there's a high risk of fiscal expansion and a high risk of additional tariffs and a high risk of disruption to labor markets either way. And all of that is inflationary or stagflationary. So therefore, we should not be encouraging the idea that there's either a further path of rate cuts in 2025 or encouraging the idea that all the risks are to the downside. This is different than the clip you just showed of Bianco. My concerns are about the policy changes and also, as I've written about and we've talked about, that the Fed is not as tight now as they think they are. It's not about that there's this persistent inflation, no landing. It's that new shocks are coming and policy is not as tight as they think.
There are two things here, Adam. One is they're not as tight as they think they are, a question around neutral, which is something that a lot of people in markets debate. Another thing is how much the Fed should try to get ahead of possible policy changes that could expand the deficit. How much would the Fed be exposing itself to incredible political risk if it weighed in? I mean, if it didn't ping pong around what the data is actually showing right now and tried to make a statement on whose programs would potentially be more inflationary at a time where the arguments on both sides contradict some of what you've been talking about.
Well, the arguments claimed, Lisa, may contradict, but the facts don't. And the Fed's job is to follow the facts and the basic economics. I think it is a risk either way. And obviously, Chair Powell and the leadership of the Fed has decided the way they're going to manage the risk is they're only going to talk about the next 3 months. and they're just going to focus on that. And that was very clear from the chair's speech at Jackson Hole. And so my push has been, at a minimum, admit that that's all you're doing and don't let people get notions about 2025 and beyond. But the second point is, we're seeing a major erosion of politics and norms and stability in the U.S. And if you look around the world where there are countries where you have that, generally the central bank ends up having to be more outspoken, more principled, and more courageous. This is like in South Africa. This is like in India. This is like it used to be in Italy before the euro, that the central bank has to stand up. And the Fed's situation isn't quite as delicate, Lisa, as I think they think it is, and as you just said, it could be portrayed, because both Harris and Trump are going to lead to expansions of fiscal policy. Both Harris and Trump are not going to roll back tariffs and are going to increase them somewhat. The Fed doesn't have to say what we in a nonpartisan place can say. They don't have to say Trump is worse than Harris. They can just say the risks to inflationary policy are higher from both.
Adam, what would you say about the fact that even though people keep talking about the deficit, the bond market hasn't woken up to it, and a lot of people think it's never going to, simply because it hasn't in the past?
It's a fair concern. I mean, I don't have anything great to say about that, because this is the dynamic you get. The U.S. is the global reserve currency. China's a mess. Europe is a partial mess. The world is unsecure in geoeconomic terms. So in relative terms, people are going to keep investing in the U.S. You were saying a little bit ago on the program about the increased interest in gold and Costco selling platinum to go with its meal kits. You know, this is Bitcoin. All these things are signs of people trying to seek alternatives to the dollar when there's no good state level, no good alternative currency. And I think all these investments will ultimately end in tears. But the fact is that temporarily gives the U.S. more room to run its fiscal policy, run its deficits. And that's part of why my forecast is that the deficits are only going to increase. It's not because I think that's good. It's not because I think it does no harm, but it is likely for the next few years.
Given all that you think about the direction of the Fed and what they're doing now, yesterday Mark Rowan told Jonathan of Apollo that this was the most expensive insurance cut that we've seen from the Fed in history. Would you agree with him?
I guess so. I wouldn't put as negative a spin on it, I guess, Anne-Marie, as that sounds, because insurance cuts have been rare in history. And I think insurance is good. You just have to be prepared once you've paid the insurance premium to write it off as a sunk cost. And that's all I've been saying. I mean, I'm on the record saying the Fed should have been cutting, maybe not 50, but should have been cutting this fall, because given where the short-term inflation outlook is, which is down, and the risks of a potential recession, it's fine for them to take out insurance. So I view that as good. But again, insurance is a sunk cost. My only point is warn people, just because you're taking out insurance doesn't mean that you're going to keep going in that direction. In fact, just because you're taking out insurance may make it less likely that you're going to keep cutting.
Adam, ahead of the election, I know you also have some thoughts on inflation, how it's central to voters, given the fact that we've had low inflation before this latest bout for 40 years. Who's messaging that the best? Are voters basically blaming Kamala Harris because of Bidenomics and they put the blame on Biden? Or is she doing a good job in explaining that tariffs may be inflationary?
I think it's more the latter than the former, Anne-Marie. Thank you for engaging with that. I mean, I'm not a pollster, but I can see that basic fact that inflation has become a dominant topic going into this election. All the polling data makes that very clear. People do feel as we look through the data as best we can, they're noticed price level shifts, right? So eggs went up a lot in prices. It's not that they're continuing to rise. In fact, some of it is they're falling. But people still feel the relative price shift they've already seen. And we know that they always feel, even if wages are going up, that's stuff they deserve. And if prices go up, that's stuff that's unfair. So they don't see the balance very clearly. I mean, they're allowed to see whatever they want, but that's how people see it. In this context, I think the Harris campaign is doing a good job building on some things that the Biden administration finally said in the last 6 months or a year, which is that tariffs are a tax, and they're particularly a tax on working people because the stuff people buy, their food, their toys, their clothes, their inexpensive furniture, their electronics, are infinitely cheaper because we allow imports and we allow competition and we allow choice. And so I think that message from Harris campaign that they would not put on a general across-the-board tariff the way the Trump people and the president, former President Trump, keep saying he will, is getting home. There's still a legacy that, when you're president, you get the blame, just like the Fed, whatever happens on your watch. So there's still a legacy of Biden that inflation occurred on his watch. And whether or not it was his fault, that doesn't matter. That's still a drag.
Adam Posen. Adam, appreciate it. Elsewhere on the Federal Reserve, the former New York Fed President Bill Dudley, in a new Bloomberg opinion column, writing this: "I've been too pessimistic about the risks of a so-called hard landing for the U.S. economy over the past few years. Although most of my conclusions that led to that view were correct, such an outcome remains very much in doubt." Bill joins us now for more. Bill, welcome back to the program, sir. It's been quite a journey for you, an intellectual journey over the years so far. I want to go through a couple of headlines, and you help me understand why you've changed your thinking somewhat. It was only back earlier this summer where you said, "I changed my mind. The Fed needs to cut rates now." Before the Federal Reserve meeting last time around, you said they need to go big now. I think they will. They did. This morning, my hard landing forecast turned out to be wrong. Bill, just walk us through how you're thinking about things currently and what kind of policy this backdrop needs.
Well, my original view was that the Fed would be late to tighten monetary policy. Check. As a consequence, inflation would go up and the labor market would get very tight. Check. Then the Federal Reserve would have to tighten monetary policy a lot. Check. And the unemployment rate would have to go up at least a half a percentage point, trigger the Somme rule. Check. But the Somme rule trigger doesn't seem like it's leading to recession. If you look at the GDP numbers, they've been very firm lately. Second quarter, 3%. Third quarter is tracking 2.5%. So even though I had the story right, it doesn't look like the conclusion is going to pan out. It's too soon to say for sure. That's why the labor market has so much attention focused on it. And I thought what was interesting, the summary of economic projections at the last FOMC meeting, they actually, in their summary of economic projections, they actually think that the downside risks to the labor market are actually greater now than the upside risks to the inflation. So they're worried about the exact same thing. And that's why tomorrow's labor market report is so important. If the labor market really starts to deteriorate, then I think the soft landing story will start to come into question. And that's why the Fed cut 50 basis points a couple weeks ago.
I think a lot of people, Bill, share your journey in terms of changing views and not understanding which models are actually accurate this time around. What in your analysis makes you think that this time is different and that some of the classic indicators that traditionally have foretold recession no longer work?
I think two things are different. Number one, you had all these fiscal transfers during the pandemic to businesses and households. So business and household balance sheets are in better shape than they typically are late in the business cycle. For example, look at debt service costs for the household sector. It's still pretty low because people locked in very low mortgage rates during the pandemic. Second thing I think is different is that financial conditions have eased a lot even before the Federal Reserve cut rates. So financial conditions were at the most tightest about a year ago. And since then, they've eased a lot. Stock market up, bond yields down, credit spreads tighter. And so even though monetary policy is tight, when you look at the level of short-term rates, financial conditions have eased a lot, and that's supporting economic activity.
What's to say we're landing at all, Bill?
Well, that's a good question. I mean, I think, the Fed would like the economy to grow, 2.5%, keep the unemployment rate right where it is. And the third quarter, it looks like it's shaping up that way. But keeping on that that nice edge, growth not strong enough to cause a resurgence of inflation, not weak enough to lead to the kind of deterioration in the labor market that would lead to a recession. That's going to be tough to keep on that nice edge.
Bill, what are you expecting for tomorrow?
I think it'll be a decent payroll employment report. I mean, I think the estimates are around 140,000. That seems like a reasonable estimate. We have to remember, though, the payroll employment has a big standard error around those estimates. So you could get something like 80,000, or you get something like 200,000, and it really wouldn't tell you for sure that the economy has actually changed momentum.
Bill, how difficult is that November 7th meeting going to be, considering how messy the data might be, considering we might not have an outcome from the election? Can you think of a time like this one that they're going into in the next month?
Well, the particular awkwardness is that there'll be another payroll employment report during the blackout period right before the FOMC meeting. I think that most of the momentum is for 25 basis points at this point. Powell basically foreshadowed that in his speech. The fact that you had all these people in the Summary of Economic Projections that only had one more rate cut in their forecast after the last meeting also tells you that it's probably not going to be 50. So I think the basic story is still intact. Risk to the labor market are greater than the risk to inflation. Monetary policy is tight. We're still quite a ways from neutral. So 25 basis points is the most likely scenario in my view at this point.
Bill, we had Adam Posen on earlier from the Peterson Institute, who said that the Fed should be vocal about the fact that they're considering the deficit and potential tariffs as a potential inflationary pressure heading into 2025 and a reason to cut less. What do you make of that? Not necessarily the Fed weighing in on that particular issue, but being more cautious ahead of next year because of it.
In my experience, the Fed doesn't, set policy today on things that might or might not happen in the future. I think they wait till those things either materialize or not. And so I think that the idea that the Fed wouldn't ease because they're worried that the election could result in a certain outcome that would lead to higher tariffs and higher inflation, I don't think the Federal Reserve would hold off because of that.
Bill Dudley, appreciate it, sir. As always, the former New York Fed President Bill Dudley there on his latest piece, How My Hard Landing Forecast Turned Out to Be Wrong. You can find that on Bloomberg Opinion. This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.